Hello, my name is Ryan Fleming, and I am the Pilot's Advisor. Welcome to the webinar today. The purpose of this webinar is to go through the academics of what we do here at the Fleming Financial Group. Everything we do here is based off of Nobel Prize winning research and statistics, and I want to get you to buy into what we do and why we do it. So today what we're going to do is explore the myths to investing, teach you how to stop speculating and gambling with your money, and then also go through the three-factor model and show you the academic approach of the Nobel Prize laureates and what they've taught us over time. I mainly work with commercial pilots and military pilots. However, I work with many other clients as well. I have doctors, NFL football players. So I can help anyone, but my expertise and my niche is definitely airlines. I work with pretty much all the major airlines. I'm a FedEx 777FO myself, so I definitely have an expertise in the FedEx 401k plan, but I'm very familiar with all the legacy carrier 401k plans. So if you have any questions, I've either heard it before or I have a good idea of what you're talking about. So feel free to reach out. Dalbar is a research group that studies investment behavior. They're out of Boston. And from 1985 to 2018, as you can see on the chart here, the S&P 500 index returned 10.86%. However, and this makes me sick to my stomach, the average investor only returned 3.67%. That's barely beating inflation, as you can see the CPI there. And it makes me sick to my stomach. And so what I try to do is work with investors and teach them how not to make the mistakes that cause this gap, this delta between the 10 and the 3. And I'm going to show you why. Why are the returns so low? Active stock picking, active management. Investors pick individual stocks, deciding whether they can go up or go down and trying to outperform the market. CEOs of these companies have access to all the data and still can't figure out what their quarterly returns are going to be. The reason is the market's unpredictable. If they can't do it, what makes you think you can? Market timing. Trying to get in and out of the market, trying to predict if the market's going to go up or the market's going to go down. The problem with this is you have to be right both times. Even if you get out at the right time, you have to get back in at the right time. Because when the market recovers, whether that's up or down in a correction, it happens very, very fast. And if you're not right both times, you might not ever recover because of that. If you do this multiple times over the course of an investment career, you actually increase your risk even more and more because you have to be right every single time. Track record investing, chasing the market. An investor will tend to pick a mutual fund or a stock that has performed well over the last year or the last 5 years when the probability of that mutual fund or stock being a top performer going forward has actually decreased and is very small. And not being a long-term investor. Most investors have a holding period of only 3.31 years. Investors tend to make emotional decisions based off of short-term market conditions, and these decisions will hurt them versus having an investment philosophy that's a long-term investment philosophy where you win by staying disciplined and doing the right thing all the time. What I just explained to you is the three investing myths. That stock picking works, that track record investing works, and that market timing works. So let's go ahead and look at the numbers so that we don't make these decisions that will cause us to speculate and gamble with our money. Why stock picking doesn't work. From 1972, if you invested $100,000, the average U.S. mutual fund returned $3.5 million over that time period. If you owned the S&P 500, it would return $6.9 million, whereas if you owned the whole market, the CRISP period, you'd have $7.4 million. So what I want you to gather from this is that the market is very, very efficient, and you should invest in as much of the market as possible and not have mutual funds where you have money managers or yourself trying to pick individual stocks because you're not going to keep up. So the average potential wealth loss to active stock management by the numbers is 3.8 million. And what this is almost 50% of your money that you're losing out on by trying to actively stock pick. Why track record investing doesn't work. A manager's ability to pick stocks in the past has little to no correlation with his or her ability to do so consistently in the future. So what we're going to do here is we're going to look at the top 30 U.S. equity funds. So these are the top 30 from 1997 to 2006, which you probably couldn't pick them anyway, but they returned 17.74% when the S&P did 8.4 and all the average was 8.07. So I look at those funds and I go, man, they really did well. I'm going to start investing all my money in those. Well, let's look at what happened over the next 9 years. As you can see, they underperformed the market for the next 9 years, and that's compounded annually. So whether they're a good performer before has no correlation whether they're going to be a good performer going forward. And let's look at the asset class returns as well. So this is looking at each asset class and seeing if there's any consistency on how they perform. I really love this chart, and I think it's a great way to view what we're talking about here. These different colors represent different asset classes here. And when I look at this, looking at all the years before, I don't see any pattern at all. Do you? If the best money managers can't predict the market, what makes you think you can? Isn't that just speculating and gambling with your money? Isn't that crazy? And here's another way I like to look at it. Do you think that news out there that happens day to day affects the market? Most people would say, yeah, it does affect the market. And then my next question would be, is news predictable? Can you predict who's going to get killed tomorrow, if airplanes are going to hit the Twin Towers? And of course, nobody can predict what's going to happen with the news. So if news affects the market and the news is totally unpredictable, inherently, isn't the market totally unpredictable? So why are you trying to predict the market? It is totally random and totally unpredictable, and you're speculating and gambling with your money, and you need to stop doing it because you're only going to hurt yourself. Market timing. This is the one I hate the most. Why market timing doesn't work. Everyone out there wants to try to predict the market, whether it's going to be going up or going down, pulling their money off the table, putting their money in. And the problem with trying to time the market is you have to be right both times. So when you pull the money out, you got to pull it at the right time, but you also have to put it in at the right time. If you do this over the course of your career, you're doing it multiple times to where the probability of you being right twice continues to reduce. So looking at this on a $10,000 investment from 1997 to 2017, if you left it in the market, you'd have almost $50,000. But if you missed just 10 days of some of the biggest movements in the market, you'd have half your money. So when the market goes down, it goes down fast. When it takes off, it takes off fast. Anytime there's a crash, it normally corrects itself on average within 71 days. So predicting and knowing exactly when to pull your money and exactly when to put it in is a fool's game. And by the time the market comes back, it's normally too late. Or if you pull your money off the table, you're basically accepting the loss in a crash. So once again, market timing does not work and you're speculating and gambling with your money. I recommend you don't do it. Charles D. Ellis, he wrote a book called The Investment Policy, How to Win the Loser's Game. And I think he had a great quote on this. He said, and this is looking at the numbers, the evidence on investment manager success with market timing is very impressive and overwhelmingly negative. So now what I want to do is give you an academic approach to this using the Nobel Prize winning research. And this academic approach is going to give you investment peace of mind. Couple principles. First of all, free markets work. Second component, modern portfolio theory. And the third component is the three-factor model. I'm going to very simply break each one of these down for you so you can see what I'm talking about. Free markets work. Free market is a best determinant of market prices because it's based on supply and demand. All the available information is factored into the current price, and only new and unknowable information or events can change that pricing. The randomness of the market makes it impossible for any individual or entity to consistently predict market movements and capture additional returns unrelated to risk. This is the principle of modern portfolio theory. Everybody knows that they need to be diversified to spread out the risk. But by being diversified, we can actually increase our return and reduce our volatility. January 1970 to December 2018, U.S. large cap, there's a return. Add in a little bit of small, and then let's add in some international. If you look at this, the return actually goes up to 10.46% over that time period, and the standard deviation goes down. So we've actually reduced our risk by spreading it out and being more diversified. Modern portfolio theory. Most people understand that the markets are efficient. Most people understand that they need to be diversified, but this last one is one that many advisors don't even know about, and I think it's the most powerful. It's really using Nobel Prize winning research to allow your portfolio to work for you. So it's called the three-factor model. Eugene Fama and Kenneth French came up with this, statisticians from the University of Chicago. It's based off of 50 years of sound academic investment research, and it's a disciplined approach that seeks to capture market returns while also managing the market volatility. The first factor is the market factor. Most everyone knows this, but we'll go through it. Equities are riskier than fixed income. They historically have provided a higher rate of return. Here's the numbers. 1926 to 2018, U.S. large cap stock 9.99%, T-bill 3.34. So what does this say? It says we want to have equities in our portfolio. We need to own equities if we want to make money and beat inflation. Second factor is a size factor. Small companies are riskier than large. They historically provided a higher return than large companies. Here's the numbers. You can see there's a 1.3% premium owning small companies in your portfolio. They're riskier, but over the long term, they're going to give you this premium. I'm not saying don't own large, don't own the S&P 500. You want to own the whole S&P, but you also want to own these other asset classes. The third factor, high book-to-market value stocks are riskier than growth stocks, but they historically provided a higher rate of return. As you can see here, a 1.8% premium over the long term. Own the S&P, own growth, own value, own them all, but the value stocks are going to give you a premium. We want to have exposure to them in our portfolio. This is looking at it from 2000 to 2019. As you can see, U.S. large cap, S&P 500 returned to 191%. But look at these large value, emerging markets, small value. You can see that they crushed the S&P 500 over the same time period. It's because those premiums over the long term are spitting out that 1.7% premium compounded annually. It's not linear, meaning it doesn't happen every single year, but over the long term it happens. So you got to play the long-term game and be disciplined with your approach. This is the exact same data, just showing it on a bar graph. As you can see, the lowest expected return of all these asset classes is the S&P 500 down here. One of the biggest mistakes I see is pilots have 70 or 80% of all their money in the S&P 500, which is still good if you're disciplined about it and do it over the long term. But I'd much rather have exposure to all these other asset classes, be more diversified, and also getting a higher rate of return over the long term. But that's just me. The numbers don't lie. So what I'm going to do now is I'm going to show you an analysis. It's something I do called a portfolio MRI that I do for any of my prospects and my clients. And what it is, it's where I go into their portfolio and I really dig into how they're invested and can show them what they're missing out on. So this is a Delta Pilot's 401k. The mutual funds that he had, you can see here all the Fidelity mutual funds with this broken down of an asset allocation. And what I do is I go into each mutual fund, I pull all the data, and I see what asset classes they have exposure to, and then I take historical returns and spit out numbers of what they could have versus doing it the way they're doing it now. Okay, so this green right here is his portfolio. He's got about 30% in fixed income, which we can talk about at a later date, but let's focus on the U.S. equity and the international equity. I just showed you the numbers of you want to have exposures to the value and small here, and you see he has very little exposure domestically and also very little exposure with small stocks internationally. This column over here would be a 70-30 split comparing the exact same using Nobel Prize winning research, how to build a very efficient portfolio, maximizing your return and minimizing your risk. You can see these numbers over here, 12.75, 12.75, 10, and 21% here in the small international. So these are the ones that scientific research, Nobel Prize winning research tells you that you should have. So let's see the effects of it over time. If this person invested $100,000 in 1972 with the asset allocation they have in their portfolio and let it do its thing, they'd have $5.37 million. But if you do it based off of Nobel Prize winning research, you'd have $11.5 million. That's a huge gap, and it's like overwhelming. But when you consider the premiums that these asset classes give you over the long term, it adds up and compounds year to year. So you want to have exposure to these asset classes. Nobel Prize winning research and statistics tell you that this is what you should do, so you should probably do it. This graph here is called the Markowitz efficiency frontier, and just to give you an example, is I can plot somebody's portfolio on here, and let's just say somebody had all their money in the S&P 500. So right here's where their portfolio would fall on the efficiency frontier. They have an 18 in the standard deviation, which is risk. But if they had built an efficient portfolio and they're happy with the returns of the S&P 500, you'd come all the way over the line here, and you could basically cut your risk in half by building an efficient portfolio. Conversely, if you're okay with that amount of risk, you should be getting an extra 2% premium by coming up to the line here and coming over. So we look at how to build efficient portfolios as well. Engineering a portfolio is not as simple as just grabbing a couple mutual funds and calling it good. You really need to dig in and find out what it's actually doing. Get through these last few slides. This is basically just showing you over the long term, equities are going to outperform fixed income. So you can see there's the premium, and that's the one that we all know about. This is the small risk premium. Every 5 years, they're going to outperform 57% of the time. The longer you go, it goes all the way up to 83%. Get that extra 1.7% premium every year. And then last couple slides here, the value risk premium. You can see the numbers again. Over a 20-year investment portfolio, 94% of the time, value is going to outperform growth. We want to get exposure to those. So I tried to make this short. I hope you enjoyed it. It's all numbers based off of Nobel Prize winning research. The numbers don't lie. What I want you to take away from this is understanding the academic approach here. That the market's unpredictable. No one knows the future. If they're telling you they do, they're lying to you. Stop speculating and gambling with your money. Do it in an academic way and have investment peace of mind. You have to buy into an investment philosophy, and this one that uses Nobel Prize winning research and statistics is a great way to go. The long-term academic approach is how you win. If you want to reach out to me and want me to do a portfolio MRI for you, I'm here, and I'd love to talk to you. I hope everybody has a wonderful day.